Welcome everyone to the Bell Asset Management webinar, Positioning for the Post-COVID Consumer Recovery in Global Equities. My name is James Biggins and I'm a Sales Director at Channel Capital. We are the distribution partner for Bell Asset Management. Bell Asset Management is a global equities manager based in Melbourne with two investment strategies, the Bell Global Equities Fund and the Bell Global Emerging Companies Fund. Matt, if I can get you just to go to the disclaimer slide, that'd be great. If you could just take a moment just to read our disclaimer, that would be fantastic. Thanks, Matt. Today, I'm joined by Ned Bell, CIO of Bell Asset Management, and Nicole Mardell, Senior Global Equities Analyst. Ned and Nicole are going to provide their perspectives on a few things today. Firstly, a global equities outlook for 2021 and the long-term view for 2022. Why consumer discretionary and consumer staples are benefiting from a post-COVID recovery, and Bell Asset Management portfolio research focus for 2021. A brief background on our speakers. Ned has over 20 years of experience in the investment management industry and is primarily responsible for the return outcomes of client portfolios and providing investment leadership. Ned is also responsible for recruiting talent, organising, mentoring at the investment team in the Bell way of thinking. Nicole also has 20 years of experience in the investment management industry and has primary research responsibilities as a global SME generalist and is the co-lead on consumer discretionary and consumer staples sectors. More broadly, we see several reasons why global small and mid caps make sense in a client portfolio. We see the potential growth opportunity, also getting less risk from a valuation perspective than other growth assets, and diversification. When you add the Bell asset way of defining the SMid cap universe by applying minimum market cap size of 1 billion, return on equity 15% or greater for 3 consecutive years, and a quality score with a fundamental and quality test, you get exposure to an investment solution that's delivered strong long-term returns with a low risk profile. The webinar today will run to 1:15. You can submit your questions in the Q&A box down below. So from there, good afternoon. Ned and Nicole, how are you today?
Very well.
Excellent to hear.
Yeah.
Ned, we might start with you with the audience, but I thought we might just get a bit of an update on recent positioning and then also just performance as well.
Yeah, sure. So thanks everyone for joining. So first of all, let's talk about performance starting out because it's obviously topical. I mean, just as a starting point, I think the historical performance has still been very strong. So the last 3 years, we've been able to generate 13.5% per annum against the benchmark around 9%. More recently, there's been a pretty big change in terms of the market activity. Now, clearly, in the last 3 months, so we want to hit this on the head sort of straight away, but we have lagged the benchmark, so I want to be open about that. And there's a few reasons behind that, but one of them being that in the 3-month period to January, we saw a really big shift away from basically defensive quality names into highly cyclical names, into clearly a lot of the really speculative names. And so, companies like Plug Power, Moderna, GameStop, all these sorts of things that frankly we wouldn't touch with a barge pole, have had spectacular performance. So obviously not participating in those parts of the market, that's weighed on us a little bit. We've also had, we haven't had exposure to some of the more cyclical areas of the market, like energy's up around 35%. Within the actual small mid-cap asset class itself, in USD terms, the SMid cap index is actually up about 22% over that time period, and value is up 27%. So it's not kind of a huge surprise. It's always disappointing when you're lagging a little bit, but the reality is you go through this every 5-10 years. You go through a period where our approach, i.e. only investing in quality companies with valuation sensitivities out of favour at the same time, and that happens to be right now. The good news is that, and this is kind of getting into sort of more positioning, is that always coincides with when we find the absolute best opportunities to add to the portfolio. And we'll touch on that maybe a little bit later, but I mean, that's where, interestingly, particularly in, say, December and January, we're still finding really good things to buy. At a time when the markets are absolutely at their highs, the speculative frenzy has been, there for everyone to see. We're actually finding really good value there, which is really important. So we feel really confident that, that always sets us up for a great period of alpha generation going forward. So So that's a little bit on performance. Maybe just on the next page, really just highlight some of the names that have actually contributed to the performance over a couple of time periods. And there's a few, I'd say there's a few surprises here. First of all, if you actually look at the performers over 3 years, every single one of those stocks is a healthcare stock. So that's pretty different. I think most portfolios in this space, particularly in the last year or two, have been very tech heavy driven. We've actually been able to find a really interesting corner of the market being healthcare and generate terrific alpha there. And then more recently, in the last 12 months, we're still generating really strong returns and finding great companies. Some of those businesses that we were able to pick up actually during the drawdown of last year. So companies like Align Technologies and Yeti, really interesting companies will follow for a while. And also the other thematic, I guess, would be that some of these companies have been real beneficiaries of the COVID environment. So we're still generating really good absolute returns, good alpha over a longer time period. And we think there's a strong case that we will sort of mean revert on that basis. So those would probably be the main points I'll touch on from a recent and long-term performance perspective.
Okay, that's great. So that's looking at the past. Now let's look forward.
Yep.
How are you seeing global markets for 2021, and maybe just some thoughts about even longer term than that to 2022?
Yeah, it's a good question. So for this year and next year, I think where we sit now is effectively markets are pricing in this very strong recovery in a post-COVID world, and we're obviously seeing good economic recovery. There's no doubt about that. And as far as small mid-cap is concerned, probably the thing that excites us the most is the earnings trajectory and the earnings leverage we expect to see in the next 2 years. And we've talked about this before, but if you look back to post the dot-com boom and bust in the early 2000s and post the GFC, if you bought small mid-cap stocks after that period, those earnings troughs, the returns have been absolutely phenomenal. And we honestly feel like we're in the third of these earnings troughs and recovery. So the earnings recovery to come in a post-COVID world, I think is going to be very, very strong. And we think that's going to drive a period of exceptionally strong performance. As far as valuations are concerned, clearly another really topical, discussion point in markets, particularly as interest rates are picking up. We still find good value here. Again, the asset class itself is trading on about 22 times earnings. But again, that's against the backdrop of earnings expectations have probably still got a fair way to move up. And I think one of the sectors we're going to talk about today being in the consumer sector, that's where we probably see the biggest gap between consensus expectations for earnings and the actual reality that will probably unfold. So long story short, we're actually really optimistic. We think that there's, particularly in the small mid-cap space, that earnings kick post-COVID has still got a long way to play out. So from investors' perspective, I haven't missed out yet.
Yeah, fantastic. Now, Nicole, over to you. I know when advisors, look at what's happening on the macro side of things, they then try to look at sectors to play that theme. And I know with your, specialty in that consumer discretionary and staple space, and the Bell Global Emerging Companies Fund actually allocating 25% of its capital to those two sectors. Starting with consumer discretionary, what is driving the earnings higher for the mid-cap universe?
Yeah, look, on page 5, we highlight our key consumer exposures. Let's take discretionary. So within that, there's some really interesting dynamics at play in this sector. First and foremost, there's a lot of pent-up demand that's yet to be realised across a number of subsectors. And let's remind ourselves that consumer represents about 75% of the US economy, and that consumer has just been flooded with a whole bunch of cash. And they're still in lockdown. But even despite that, when the markets open up, we're expecting earnings estimates to significantly beat. And that's the interesting point here. Earnings estimates for this year are still pricing in a scenario where the COVID tailwinds just disappear. So we see it differently, especially when you think about how the consumer has changed their behaviour over the last year. I mean, we're spending more time at home. We view our home as a place of work and leisure. We're spending more on our home, renovating it, repairing it, project works around the house. We're supporting local travel and outdoor experiences. So from a mid-cap perspective, we hold names that are actually quite unique, and they're really marching to the beat of their own drum. And where on average, we're expecting, EPS growth of 20% over the medium term. So, let's take a couple of these examples up here. I mean, Pool Corp is a distributor of pool supplies. It actually supplies all the necessity-based products you need to actually keep a pool. So all the equipment, all the chemicals, that commands 60% of revenues, and it's providing a great recurring revenue stream with stable margins. And then you add on the fact that it's 20 times bigger than its largest competitor, because they're all small family-owned businesses. That goes a long way to underpin the 15 to 20% growth in EPS that we're expecting. And then you look at what happened last year. A lot of repair and maintenance work was happening. That commands 25% of revenues and also provides a second level of recurring revenue stream. And then currently, I mean, these guys can't put pools in fast enough. So there's a lot of drivers, demand drivers for a name like Pool Corp. Yet is another example. It's at the infancy of its growth in a niche category with a rare brand, low awareness, but really strong brand authenticity and loyalty. You may have come across some of their products.
Yeah, no, we've talked about it in the past, Ned and I. Yeah, certainly.
So, we know two brothers started the company in core drinkware and hard cooler products that for their hunting and fishing needs that apparently weren't being met by the market. They've now evolved this and really disrupting the market with a broader range of products, like moving into soft coolers that you can use for multiple uses, so you can take to the beach or when you go camping. And in doing that, they're trying to capture new customers. They're trying to capture more female customers. So they've got a really measured way of growing, and this is allowing them to really focus on niche areas, which will go a long way to provide a lot of sustainability behind the 20% growth that we're expecting out of this company. Tractor Supply, I have to talk about Tractor Supply because it's one of our top discretionary holdings. We bought this when it was $70. It's now pushing $160. It's a unique retail offering. It really services rural communities, and it sells everything from small tractors through to chickens and the feed for the chickens. And it really commands these rural areas, especially again, because a lot of their competitors are the moms and the pops. So it's now being run by a young 50-year-old CEO. He comes with an extensive digital background. He actually came from Home Depot.
Which is another name that you've got up there.
Yeah, absolutely. Yeah. And he was a numbers guy at Home Depot. And Home Depot is really significant because it's one of the best retail stories in the US. And the management team has just executed phenomenally well to lift their return profile well into 40% level. And Home Depot is the number one home improvement retail story in the US. And just as an aside, it's actually getting stronger in its own right because its smaller and less capitalized peers are really struggling to keep up. But I bring it up here because we own it. We've owned it for a decade. So we know and we've seen what's happened. And so we're really excited with this new appointment from Home Depot into Tractor Supply. And he's already pushed through quite some strong initiatives that we see will see sales trajectory double and really lift their return profile into the 20% level. So things like he's offering lawn and garden. He's putting those on the outside of stores. So if you think of Bunnings here in Australia, he's putting all those garden centres on the outside of all his stores. And he's actually increasing their drive-through capacity, which is an extension of all the investments that he put in place last year, where he established curbside, contactless pickup. And the interesting thing is the market's still only discussing this. They've yet to really quantify the financial impact. So from our perspective, before these initiatives, we had a total expected return of Tractor Supply pushing 20%. Now with these initiatives in place, that expected return goes up to 30%. So, these three names are all quite differentiated and I think go some way to explain the strength we're seeing in this sector, in this part of the sector.
Yeah, fantastic. And I see that we've got some larger names in there, which is Nike and LVMH, and, really interested to kind of get your thoughts on, how they continue to find interest from investors as well, and what your thoughts are about having, those names in the portfolio.
Yeah, well, that actually brings up the other interesting dynamic in the sector, and that's that COVID's really expanded the divide between high quality names and low quality names across the sector, but specifically when you look at subsectors like retail and luxury. And, these three large cap names here, they're all exceptionally strong companies. They were before COVID, and through COVID, they've actually put things in place that's actually strengthened those positions. And it's not so much as looking at Nike and going, we know the brand, it's going to be strong. It's more about understanding why that brand is strong and what management are doing behind the scenes to continue to execute, keep sales strong and turn into profitable growth. And all of these large cap names generate return on capital greater than 20%. And they're all names that we've been researching since 2005.
Yeah.
So let me just take Nike as an example. I mean, we've owned that for 8 years, and over this time period, it's gone up over fourfold. So we got in around $30. It's now pushing 140. And it's been under a new external CEO since the beginning of last year. And he comes with real strong digital and technology background. And he unveiled a new long-term strategy around their digital commerce last year, which with their planned investments, they see now their digital penetration of sales reaching 50% by 2023. This is up from 30%. Now, bear in mind, they were already 1 to 2 years ahead of Adidas before this. So this just bridges the gap between them even wider. And Adidas is going off and it's got its own problems with its own strategy. So all this really underpins the high teens EPS growth we see coming out of a name like Nike.
Yeah, fantastic. And I think you're seeing that where digital is the new battlefield for consumers, which is really interesting.
Yeah.
And then moving on to the staples sector, we've seen valuations pull back last year and then kind of pull back again the start of this year. So really kind of where do you see a catalyst for that re-rating of that valuation for the sector?
Yeah. It's a really interesting dynamic happening in staples too, and you're right there. From a relative sector perspective, valuations here are at 10-year lows. I mean, the global consumer sector is trading at a discount of 6% versus a longer-term historical average of 19%. So that's like a massive anomaly in the market and somewhat understandable, but not justified in our view. I mean, look, we've just come through COVID, touch wood, and that's arguably a net benefit to a lot of staples names, given the focus on health and wellness, health and hygiene, eating at home, staying at home. And that's, created some natural skepticism in the market. And these guys aren't cyclical, so they have lagged recently, but there's a significant disconnect between that relative valuation and the fundamentals. And when the more normalisation comes back into the market, that gap will close. And underneath, there's still a lot of names that are doing really well. So giving you a bit of colour on that, maybe I break it down into 2 buckets again. I'll probably start with some of the large cap names. Costco and Estee Lauder, they're just powerhouses that continue to drive 10 to 15% returns. Take Costco. We actually owned Costco when it was a SMID cap way back in 2014.
Yeah, right.
It was about $115. It's now pushing $350. I mean, it's got an excellent track record, generating returns on capital greater than 20% for the last decade. And it's just continuing to get stronger. I think it recently posted its 40th consecutive quarter of positive same-store sales.
Wow.
I mean, that's phenomenal. And that's all thanks to their membership-based model, which is really, really powerful. And when you think about it, Costco's driven a massive shift in US retailing towards this warehouse approach and membership-based approach that only now is being replicated in other names that have niches themselves like Tractor Supply.
Got it.
Another name here you want to touch on is Estee Lauder as well, because, we've owned that since 2012. We got in at about $60, $63. It's now pushing $300. And what's happened over the last part of the decade is much stricter cost management, which isn't that hard for a prestige company like Estee Lauder, but also a lot of top-line management, which has given them clearer diversification across region, brand, category, channel. And that has actually given them a unique ability to continue to manage through the changing dynamics that they've seen through the consumer over multiple years. And plus, with repeat purchase rates as high as 60% still today, that has allowed them to exploit that diversification and pivot into growth channels like online, into growth categories like skincare, which is 45% of the business, into growth regions like Asia, which is 25% of the business. So all this is a reason for their continued strength and a reason for why it holds position in our portfolios. And before I finish, if I can touch on some of the SMID cap names, let's talk about Couche-Tard. I mean, Couche-Tard is a name we've owned since 2013. It's a unique and niche convenience store operator where the management team over multiple years has been really good executors and deployers of capital. And it's benefited a lot from having pre-existing relationships with oil companies who have non-strategic gas stations. So they've acquired them, turned them profitable, and sat back and reaped the benefits of scale. And Couche-Tard and 7-Eleven are the 2 main convenience store operators across the US, and they still only command 20% market share. So it's still a highly fragmented market with lots of room still to grow. And interestingly, with convenience stores, they're very highly EPS accretive. with good synergies. They make a lot of money, and make a lot of cash, I should say, and with very short paybacks. So that's an underappreciated element of the story behind Couche-Tard. And then you add on the fact that 85% of its products are inelastic. So, they're necessity based. So that's great for growth and margins. So whilst a name like Couche-Tard's lagged recently, we think it's being undervalued, especially from a relative perspective. And lastly, I'd like to touch on Church & Dwight. This is a great company in our view. It's a maker of household and personal care products, and it's got a great strategy for growth where it takes lower tier brands, drive innovation behind them, and really carves out strong niches. And that comes through in their market shares. So where they've got like 80% of their products commanding number 1, number 2 positions. And you really don't see many other products or brands in key categories that they have. So they've got brands like Arm & Hammer, which is a clean product in 85% of US households. They've got Nair for hair removal. They've got First Response pregnancy kits. They've got a range of gummy vitamins for adults and children. You really struggle to see other brands on the shelves here. And it's a great place to hide in staples because it's less commoditized. You think breakfast cereals, this strategy really allows them to generate 2 times the category growth rate and margins 400 to 500 bips higher than their peers. So their profitability profile is phenomenally strong. And then you add on great capital deployment, these guys are generating an EPS CAGR of 10%.
Fantastic.
Yeah.
Thanks for all that depth. That was fantastic. Yeah. Now, I might throw it to both of you for this, but I don't know who would like to, but Ned, you kind of touched on it in your opening remarks, but why do you continue to see that small and mid-cap companies, for both of you, are probably going to continue to or potentially outpace large cap going forward? It'd be really interesting to kind of get your thoughts on that.
Yeah, I think, I think a couple of key points. First of all, the large cap stocks, it's no secret that they've led the market higher. And the last 18 months, we've had this incredibly skinny rally led by a handful of stocks. And if you didn't own 5 or 6 names last year, you just didn't outperform. It's almost that simple. The magnitude of that differential was so high last year, it's frankly just extremely difficult to see how that can continue. And I think there's a much stronger case for that to mean revert. And the other issue with those large cap names, and look, the companies are terrific. They're great businesses, but they are so over-owned, not only by growth managers, but by value managers, probably in fear of their life, frankly. And the other point is that a lot of those companies in particular, in many ways, you think like Amazon, for example, they were beneficiaries of COVID. So they've actually, you could make an argument that some of those companies have actually had 2 or 3 years of earnings growth pulled forward into 2020. But what that means is that going to 2021, when that growth rate starts to pancake, the multiples will compress because the growth rates are slowing and you're getting inflation ticking up, which is terrible for high PE stocks. So that's kind of my first argument why the large cap growth sector could actually give back a bit of what they've given the market in the last couple of years. In terms of the small mid cap stocks, I think a lot of the points Nicole made really touch on it, which is this idea that it's like the Christmas present hasn't been opened yet. It's like the second half onwards when the US economy, when people start coming out of their apartments and there's this huge pent up demand. Let's face it, the US economy is all about the consumer. That's the big point. And there's a lot of pent up demand pre-stimulus. You add stimulus on top of that, and the nature of Wall Street, analysts is that they don't look very far beyond the end of their shoes. So they're not gonna get too heroic about their earnings estimates for the second half of this year until it hits them in the face. Just through our discussions with companies, what they're talking about is wildly different to what expectations are. So that's where we think there is a legitimate disconnect. It's not just in the consumer sectors, it's other parts of small mid cap where the earnings recovery has still got a ways to play out. And I think there's obviously just general uncertainty amongst the investor community about the steepness and the trajectory of that. But I think, when we sit back and we think about how a small mid cap stock's going to play out over the next 2 years, we feel very confident that there is a very strong case for a very meaningful earnings rebound and potentially some multiple expansion also. So if you add those two things together, you've got a recipe for a really strong period of performance in an absolute sense. So those have. Is there anything else?
Well, why don't we go to the slide that kind of talks about some of the big names that we've
It'd be great to see.
Sure. So maybe, if we just, so maybe if we go to page 7.
Thanks, mate.
Yeah.
Page 7. So, and this is kind of, I think this is kind of circling back to, and maybe I'll touch on some of the names, you touch on the consumer names, but this is circling back to the original discussion around the idea that we're still finding things to buy, which is phenomenal. And we feel frankly lucky, but but I think, just breaking these names into a few buckets. I mean, a few of them like Couche-Tard we've talked about. We've actually reintroduced that back in the portfolio after a period of weakness. So again, really compelling valuation. Same can be said for Deutsche Börse, which is a stock that we've owned on and off in our strategy for 12 years, I think. And then the other one being O'Reilly Automotive, which is also in the consumer space. Again, another, like Nicole was saying, some of these stocks where they've been viewed by the market as being temporary beneficiaries of COVID, but that underpinning will subside. We actually think they're still doing really well, and it's lagged a bit. So we're still finding great things to buy. Ritchie Brothers is a newer name that's come into the portfolio, slightly smaller one. And again, these companies, they're trading on good valuations. They're very profitable. You can see that the returns on capital of these businesses are terrific. Like they make a lot, to Nicole's point, they make a lot of money. And they're in this really interesting phase of their growth trajectory. And that's where it feels like, as opposed to large cap growth, where, as I said, a lot of the growth was pulled forward last year, it's almost the complete opposite. It's almost a mirror opposite for these types of names. So those are the main points I'd touch on.
Yeah, I'll just highlight one name here, Fox Factory. For the avid cyclists in the audience.
Which I am, yep.
They make performance shocks and forks, I believe.
Yes, they do.
Considered industry leading. And they started with shocks for hardcore bikers and mountain cross bikes. And they've now introduced these into Ford, really at the high end sports end of the offering packages. So you could buy a standard, say, Hilux, or you could buy a Hilux special edition, sports edition, and that comes with the Fox shocks. So this strategy for them is great because it really it increases their addressable market for one, and it actually deepens their aftermarket penetration, which is great for margins because they're high margins. And because it's all backed with very good, solid capital management, it puts a lot of credibility behind what we see being high single-digit growth with some margin from scale and improvements driving double-digit EPS growth. So that's, one name.
Yeah, I mean, the other one for the cyclists out there is Thule down the bottom there. So once you've got your bike with your Fox shocks on it, you can put on your Thule.
Exactly.
Carrier on the back of your Ford Raptor.
Yeah,
exactly.
And there's lots to like about Thule too, because it's got great. It's a niche brand. It's got strong brand equity. It has no marketing budget. All of its revenues come from word of mouth.
Yep.
So that points to the strength in product design and quality. It's got all those competitors, small or regional, very R&D focused, and low capital intensity. So the story behind Thule, for ages has been, the cargo carriers and the roof boxes where they've got over 50% market share. But now going forward, it's more about the other smaller categories like kids segments, so the baby carriers like the prams and the like, and even the bikes that they have. And to that point, they can't make bikes fast enough at the moment. It's all those smaller brands that don't have the same cachet and support that the bigger core brands have, but herein lies the opportunity. And specifically with Thule, the market actually, there's going to be some investment behind these smaller brands, but the market expects a lot more than what actually will happen because arguably they don't really understand the dynamics properly in the business. So as a result, their margin structure will remain positive, which will continue to support double-digit growth. And as that plays out, that should play into the valuation as well.
Fantastic. And I think it's also important for the, advisors on the call that you can see the market cap there. And, while they seem like large companies, in a global perspective, they're still very small. So it's good to see that there's a wide diversity of market caps within the portfolio that have made into the portfolio over the last year.
Absolutely.
Now, changing tact, and we did kind of come up on the slide before, is around ESG. We really do see ESG coming up more with the conversations that we have. And I guess from a small mid perspective, Are there ESG champions? Do they have the balance sheet, or do they have the ability to kind of affect change? I'd really kind of be keen to get both of your thoughts on that.
Yeah, I'll touch off on. I'd make a couple of quick points, maybe. I mean, and again, this slide I think gives people just a good sort of backdrop, because I mean the answer is there are, and it's no secret that the Europeans are the gold medalists when it comes to ESG, and like some of those sustainable champions like Novozymes, Croda, Christian Hansen, these companies are the gold star rated ESG companies in terms of what they do, and so I think those are sort of almost the creme de la creme. But I mean, more generally, I mean, the other point I'd make is that we actually find a lot better high quality ESG companies in small mid cap than you might otherwise think. But it's because we have the quality tilt. It's because we're investing in companies that are very profitable. They've got the ability to invest in good sustainable initiatives and really good sort of social initiatives, environmental initiatives, and that's really important, because I think the more challenged companies, the more value type businesses that are very cyclical, they often struggle to really get their head above water when it comes to things like ESG. And if you look at companies like in the middle bucket there, we've obviously talked about some of these names, but companies like Yeti, I think is an interesting one. So they that's an example of a company that from an ESG perspective, they're very good. They just weren't all that good at communicating what they did. And once we had several discussions with them, but when they come out with their first rating, it was a AA.
Yeah, right.
It was an amazing rating. It was more around the verbalization and the explanation of what they do within an ESG framework is where some of them, it just takes them a little while to get along. There are obviously some companies that just, and they do tend to be a bit more focused in the US, that are well behind the curve and happy to stay behind the curve, which we generally stay away from. And I'll just make one point before I'll ask Nicole to jump back in. But in terms of the bottom left there, more recently, we've always been looking for, it's not just the environmental risk, but it's like, what are they doing to actually address that risk? Like because they can either be proactive or they can't. And so if you take Nike, which is it's an interesting one, because I think they always get a bad rap on all matters ESG. But if you think about from an environmental perspective, they've been quite amazing what they've done. So for example, they've got all their products, they've got 75% of their products use recycled materials. They've taken, I think it's 4 billion water bottles out of landfill since 2012 and used that in the production of their shoes. Another thing they've done, which I think is pretty incredible, which is actually where they actually merge an environmental initiative with a social initiative, is they use a lot of their offcuts to make things like basketball courts and tennis courts, and then they put them into impoverished cities and like places where, but it's effectively a donation that they're making. So it's a really positive social initiative, and I think but that's what we kind of look for. We try to dig into not only just identifying what the risk is, but what are they doing about it? Because if they're not doing anything about it, then we're probably not going to. It's a company we're probably not going to invest in.
And that plays well into, again, looking up into the positive social initiatives box. I think COVID's created a lot of social challenges, particularly for the retail companies. They've been having to face big decisions about how much do they spend money, how much money do they spend to protect the consumer, protect their employees, and then, do they actually offer employees paid time off as well? So there's a lot of companies, to Ned's point before, about they can or they can't financially, and there's a lot of companies that want to and don't want to either. Yeah. So from the perspective of the companies that we own, when we look at, say, a Home Depot or a tractor supply, let's take Home Depot, it's spent $1 billion on providing safety benefits to their employees through all the COVID safety equipment, gloves and masks, and providing free COVID tests, and they've also paid their workers time off as well. Tractor Supply has done something similar, and they've actually gone another step forward and provided a leadership program to help retain talent through the the weak period, I guess, that we've all gone through. And just to round out the question and going back to your original statement about are there some ESG champions, I'd like to highlight Church and Dwight here again, because we had a lot of discussion with management on a public rating that they have, which we kind of disagree with and wondering where it came from. I mean, over the years, Church and Dwight has done a lot of work to increase the transparency of the product ingredients they have, such that now they've got a safety data system that's available online.
Okay.
And there's not many consumer staples companies that have that. They've also worked a lot to decrease the number of ingredients that they have in products. So one of their key laundry detergents has only 6 products versus the average of 20 in their peers. So you have to question kind of what are the other 14 products doing there? And they're really driving hard the message behind baking soda, which is their core product. It's a natural product. It's a natural ingredient, and it's across all of their products pretty much, from household cleaning through to toothpaste. So they're doing a lot with new product development and innovation to really raise the sustainability profile of their product portfolio. So that's just another point. Oh, and Pool Corp is another example of an ESG leader where, they're constantly putting out eco-select products.
Okay.
That are helping the consumer save water, conserve water, reduce water, improve air quality, reduce noise. And, it's not, some of these companies, like Ned was saying with Yeti, they don't actually realise how good they are until they start talking about it. They're forced to talk about it through engagement that we have with them, and just general pressures that come from the market in having to raise the profile on a lot of these issues.
I think one other really big one is also the healthcare sector. I mean, in a COVID environment, you've got all these healthcare companies, the manufacturers of vaccine, they're doing it at cost. They don't have to do that, but from a social perspective, that's a pretty phenomenal step forward. And I don't think they get a lot of credit for it,
No.
but I think that's a pretty big, obviously CSL, they're doing it at cost, and as the others are. So I think that's a really obvious one, actually.
And I think it's important to recognise that, ESG, there is integrated approach to the way that you guys invest. And, it's been great to see Morningstar have come out with a 5-star rating for that particular part of your process. So I think it's something that, we'll talk about more, and we keep getting questions. Now, I might just close the formal part of proceedings at the moment, and we've got questions coming through. So anyone that's got questions, please do send them through. But we might just start, Ned, with you. And one of the big ones was from Gabrielle earlier today, talking about inflation. And I think Nicole will reflect on some of your sectors as well. But inflation, what are you thinking? And then when might you have to make some changes to the portfolio? It'd be really interesting to hear your thoughts.
Yeah, I think so. It's obviously very topical because it is starting to kick, and interest rates picking up. And I think coming back to the unique nature of how the economy is trying to be stimulated at the moment, i.e. stimulated when a lot of people are locked up, there is a pretty strong argument that when it kicks, it's going to kick hard. So first of all, from our portfolio and our approach, we actually perform really well in that time period, like from a relative perspective. So, and probably one of the most recent periods was actually 2018, when inflation started to kick a little bit. The SMID strategy actually outperformed by about 11% in that year. And one of the reasons being is that, first of all, we just don't invest in companies where they suffer huge margin pressure due to inflation, because the reality is, by virtue of being a quality manager, we're only investing in companies that have got phenomenal pricing power. There tends to be a much bigger services type element to our companies too, rather than sort of like low margin garment manufacturers or like some of those consumer staples companies that are sort of commoditized areas. So the short answer is the way the portfolio is set up now is actually perfect for that environment. And I think, and the second point being, and this comes back to valuation and the argument around valuation, inflation kicks and interest rates kick, which means expensive stocks get beaten up. Now, the reality is we do have a valuation discipline. We don't pay through the nose for companies. One of the things we haven't sort of touched on is just some of the selling that we've been doing. But like more recently, we've been selling some of our stocks like Align Technologies, IDEX Labs, Sysmex for valuation reasons. They just got really, really expensive. And by selling those names and rotating into other names, it means that the average P of the portfolio has come down. And so that means we are much less susceptible to that multiple compression that is almost inevitable, I think, at some point.
And then on the discretionary or staple side, are you seeing inflationary pressures from the companies that you're talking to? Are they talking about it at the moment, or is it not really hit their businesses yet?
I think it's the obvious one's going to be the staples, and yes, there is a little bit more chat coming from these staples companies, particularly around input cost pressures and how it impacts their gross margins. I mean, for obvious, the rise in oil price is hitting their packaging costs, transportation costs started to spike, some raw materials like wheat and corn have actually started to spike as well. But, from our perspective, our portfolio in staples, they've got some really strong franchises that give them that ability to actually pass this on. The good brands are actually able to have that ability to raise prices and provide that positive leverage over the medium term. So again, you look at the names that I've already mentioned, Church and Dwight, great example of pricing power, and their margins, significantly higher than peers. Costco as well, strengthen their membership programs, not deterring, 90%. Retention rates and 98% renewal rates in membership fees. Even Estee Lauder, really strong gross margins, brand strength, and that diversification I was talking about is allowing them to actually grow niche areas. So if the likes of brands like Smashbox and MAC that are really resonating well with the young demographic that doesn't really seem to care what price they pay, and even Aveda, we're going into the naturals and organic line as well, where high prices seem to be the new norm. Also, interestingly, on Estee Lauder, that works really well is that each of their 25 prestige brands have a strong ESG underpinning, and that kind of strong association helps improve perception and helps drive the pricing power through their products. So all of these examples that I've mentioned have quite differentiated exposures, which helps offsets any of the headwinds, and it goes back to the point about where we start, much higher quality companies to begin with. The more traditional guys in the staple space like Nestle and Unilever, they'll probably get hit more by, some of these headwinds. But then again, if you really think about what Nestle has been doing, 4 or 5 years ago, back in 2017, new CEO came on board, drive a lot of capital, better capital allocation. So he's driven a lot of differentiation in that product portfolio now. He's gotten rid of a lot of low growth, low margin businesses. And now this portfolio is fuller of, growth areas. He's doubled down on beauty cream with higher margin, and he's left with pet care and nutrition, which have slightly higher gross margins and gives the ability to push it through. So all these pressures in the staples perspective will potentially create short-term headwinds, but over the medium term, they're really able to pass it on. And just to finish on the discretionary side, actually, it's quite the reverse because, they're not subject to a lot of these pressures. They're much more defensible businesses and actually helped a lot by the stimulus in the system at the moment. So it goes back to the points we raised earlier. Think back to the GFC. All the stimulus went to saving the banks.
Yep.
Now all the stimulus has gone straight into the hands of the consumer. Yep. Perfect for these discretionary names. So the consumer's running around with a whole bunch of extra discretionary dollars. And what are they wanting to do with it? They're looking to spend it in other ways when they can't travel anymore. So they're staying home and they're buying a Thule product. They're buying, a Yeti product for their next camping trip. Even the strong franchises that we have in a lot of the strong franchises in Home Depot and Pool Corp are actually playing to the same drum, with people viewing their home differently as well. So even though they might be subject to similar inflationary pressures, they're coming from a much higher starting point because their gross margins are much higher.
Fantastic. And I've got a question here from Sarah. This is probably the last one because we're almost out of time. But where are you spending your time in researching for this year? Like, we've got the inflation macro, but where are you also spending some other time from a research perspective, Ned and the team?
So I think at the moment, in terms of where the stocks that are most likely to get in the portfolio, there is a skew towards the small mid names, probably a bit more towards the mids, if you like, the 10 to 25 billion range, and that's more coincidence than anything. There's no sort of real method to that. I think the small cap stocks, like the small cap part of our cohort, particularly the ones with a bit of growth behind them, they're very expensive. So we've intentionally tilted the portfolio up towards some of those more mid-cap sectors because we're just finding better value there and better upside. So now that's not to say that we won't reverse back there. And I think what's actually going to happen is that you'll see with this interest rate kick up, you'll see multiple compression in the small caps, the small cap growth names, because they are so over-owned and so loved, and they don't have the magic ingredient of liquidity.
Yeah.
So when they get hit, they stay hit generally. That can create some phenomenal opportunities for us.
Okay.
So we've got a bit of a playbook, if you like, of names in that sort of 1 to 10 bill range, and I'd say that there's probably 20 to 25 names that are sort of like we really like, and it's really just at the right price. I think, I guess from a sector perspective, we're probably skewing a bit more towards IT, consumer discretionary, consumer staples would be sort of 3 sectors of particular interest. We've obviously got pretty good healthcare exposure at the moment. I think within the IT space, this is actually quite interesting because this is actually about 26% of the portfolio. But again, these names are not very expensive. They're very different to the large cap tech names. And like we tend to have quite good exposure to more the services but type businesses like CGI and Booz Allen and Hamilton, these types of businesses where, again, there's been the earnings growth we hope to see largely has been pushed into this year. So there is that sort of hockey stick earnings inflection still to come in that space, and the valuations are still pretty attractive. But I'd say that there's probably 3 or 4 names there that are quite close. And then I guess in the consumer space, in the staple side of things, we've already kind of touched on this, but because of this very aggressive shift towards the super cyclical reopening trades, the staple stocks are just trading at ridiculously low valuations and are pricing in a unrealistically poor outcome. So that's where we probably see one of the biggest disconnects. And then the second one being, again, it's in the discretionary side. So like 2 names just to put it out there would be in the discretionary side. Ferrari is a company we'll follow for quite a long time. It is at probably the upper end of the mid cap spectrum, but that's a company. That's more of a luxury company that makes cars rather than a car company that doesn't make money.
Yeah.
So that's one we'll follow really closely. They've got a really interesting growth trajectory to come in the next couple of years in terms of new product rollouts. But again, you're starting to see these names start to tip over a little bit, and then.
Ferrari has really pulled back. It was trading at stupid PEs, and now it's come back to something a little bit more realistic, and at a massive discount to its main peer being Hermes. And when you look at Ferrari, it's generating return on capital at 30%, and which is significantly higher than even the highest quality luxury names that are only producing 20% return on capital, like Hermes is doing. So that is really making it quite attractive. And underlying all of that is, as Ned's saying, a lot of growth that's coming out of Ferrari. A massive game changer for them is going to be introducing their first SUV into the market in 2020. Massive gross margins on that too. The hybrid vehicles that they've introduced, massive gross margins. We're talking 60-70% gross margins. Their order book is as strong as it's ever been. It's out 1.5 years. So it really wasn't any weak point during the last year.
And they don't need to buy Bitcoin to make money.
No, they don't. And the other thing is they've recently been certified in Italy as the first company to allows equality in pay across their workforce.
Wow.
So when you add that to the hybrid and EV technologies they've got out there, ESG is a really strong tenet in their investment story. So it's actually
probably
really
been understood
pretty
on that. There's probably scope for that you probably expect that to pick up in the next couple of years.
Most definitely.
So
okay. Well, that concludes our session for today. So Nicole, Ned, thank you so much for your time. Everyone on the call, thank you so much. We've got our details. If you do have any further questions, we will be sending out the presentation post this event. So again, thank you for your time, and we'll see you soon. Cheers.